So, good afternoon, everyone. Thank you for joining this webinar from Whitley Stimpson. That's about making tax digital for income tax. My name is John Skinner. I'm one of the senior managers at the firm. If you have any questions during the course of the webinar, if you could either post them on the Q&A icon at the bottom of your screen, and we'll pick these up at the end, or if you can't find that button, please respond to the email that you received where we first told you about this webinar happening, and we'll come back to you via an email. So I started work at Whitley Stimpson in 1989, which seems a long time ago, but was here when was the last major change to the income tax administration system imposed by the Inland Revenue. That was back in 95, 96, when the self-assessment regime was first introduced. It's worth emphasising initially from the outset that the Making Tax Digital regime is not involved in changing the rate of tax or when tax is paid. It is imposing a change in behaviour patterns for certain types of taxpayers. And the aim of the webinar is to bring those changes to your attention so that when we reach April next year, when the regime starts, hopefully there won't be any huge surprises and it won't need too much adjustment on your behalf. The whole point of making tax digital unfortunately goes against what the revenue are saying, what the government are saying, in trying to reduce the amount of red tape involved in running business. This will seem quite the opposite for the most part. It does have some benefits, certainly the revenue emphasise what those are, but you can be your own judge as we go through. Making tax digital has been on the political agenda for about 10 years now, and we certainly should be much further along the rollout of this regime than we are. But other issues have taken priority in the meantime, not least Brexit and COVID have meant that the implementation has been delayed successively over the last few years. So what's the point of making tax digital? And that's the first slide that you can see, mind the gap, because what the government and the revenue are trying to do is reduce a thing called the tax gap. Now, this is a theoretical amount of money that the mandarins in Whitehall calculate is underpaid in tax each year. For instance, 22-23, the tax gap was estimated to be essentially the best part of £40 billion, of which essentially 10 billion stemmed from taxpayers failing to take reasonable care in their tax affairs. Equally, the new regime is aimed at moving away from the revenue's outdated IT systems, which are essentially, they're already at capacity, and making tax digital has involved the production of a whole new system that will hopefully take the pressure off the old system. But equally, making tax digital is designed to improve the way in which taxpayers plan their finances and improve budgeting, if nothing else, so that when tax falls due, funds have been earmarked to settle the debt as promptly as possible. For those amongst you who are familiar with making tax digital for VAT, because you run a VAT registered business, you're currently obliged from April 2019 to keep accounting records digitally and make quarterly submissions to a specific part of the revenue's computer systems. Now, making tax digital for income tax will have a similar effect in that you'll be obliged to keep digital records if you're self-employed or you're a landlord, and make quarterly submissions, which we'll come on to again in a bit. It's certainly worth emphasising that if you run your business through a limited company or you own property through a limited company, the new regime that starts in April next year will not affect you. It probably will at some point in the future, but the revenue haven't committed themselves yet to a date when that expansion will happen. And equally, if you run a partnership or you own property in a partnership, you're not going to be affected in April 26. Making tax digital for income tax is being introduced across 3 tax years and uses what the revenue called qualifying income as a threshold. This is essentially your sales figure from your tax return. If you're VAT registered, it ignores the VAT element of your turnover. And things like earnings from employment or pensions or bank interest, dividends, they are all ignored for these purposes. It is just looking at sales from self-employment and gross income from letting property. Just to emphasize that point, it is not profit that is taken as the measure. Profit is, I won't say it's too easily manipulated, it's too open to fluctuations. So it's your turnover that is being used, and it's any combination of turnover. So if you've got small business where you're self-employed and you're also a landlord, it is any combination of your sales from your business and the gross rent from your property. So on the slide that you can see the three thresholds being used are for anyone exceeding £50,000 from April next year will need to register for Making Tax Digital, 30,000 from April 27, and as was confirmed in the spring statement this year, it's £20,000 from April 28. To put some figures on how you might get to your 50,000, if we think of a tradesman who has annual sales of £42,000 and receives rent of £7,000 from his letting agent, he might think he's no action to take in April 26. Okay, I can wait till April 27. That's not necessarily the case, because from a landlord's perspective, particularly where you're using a letting agent, your gross rent is not going to be what you physically receive from your letting agent. The landlord, you need to consider the effect of the agent taking their commission prior to paying them what they owe you. So, for example, if your agent deducts commission at 13%, in the example here, you physically receive £7,000, but your starting point is over 8,000, and that's enough to push you over the threshold for registering for MTD a year earlier than you might have thought. So, what figure will be used initially to determine whether you need to register for MTD next year? This comes from the tax return that runs the 5th of April 2025. So the tax year that ended last month, and the return needs to be submitted by the end of January next year. Now, the revenue have already written to taxpayers who I should say they're in the process of writing to taxpayers who they think will be affected by MTD by using their 23-24 returns that were where the deadline was this year for their submission in January. But it is the taxpayer's responsibility to register for MTD. Like I said here, the revenue will not tell you to register. It's part of the self-assessment process. Sort of the clues in the name, you self-assess. You have to self-police. You have to be aware of what your obligations are. But the trouble is, if your tax affairs have changed since 23-24, you could easily now fall into MTD, or you might have fallen out. Say if you've had residential property that you let out and that income had previously pushed you into the system, if you've now sold that and your rental income is now gone, you now no longer have any obligation to register for MTD. So what do you have to do if you breach the threshold? There's four main categories. I'll go through them each in turn. So first of all, registering for MTD. This itself is a two-part process. And when MTD for VAT came in, it felt like quite a painful part of the process, because it involved taxpayers getting themselves a government gateway account, which generates a user ID and a password. And to create an account, you need a valid passport or a picture driving license. And once you've got your user ID and password, there's a part of the Revenue's website where you just click through, use your username and password for the registration process. And alternatively, you could ask your accountant to sign you up. But equally, this also involves the use of your ID and password. Once you've breached the registration threshold, you join in the following tax year, which is why the 24-25 returns are being used as a basis, and you then join from April 26. So that's your year's grace. But once you're in, you are obliged to stay in Making Tax Digital for income tax for 3 years, unless you sell your business or you sell the property that's been generating the rental income. So secondly, looking at maintaining what the Revenue call compatible digital records. Good bit of jargon, unfortunately, but herein lies the crux of how you as taxpayers react to this obligation. But what are compatible digital records? Essentially, it's maintaining records electronically. So rather than any form of manual system, it's maintaining electronic records. And the compatible bit means that they're compatible, so they can make submissions to the Revenue systems. So the software houses like Xero or Sage or QuickBooks, they're not the only ones, there's the big three, would try to convince you that you must use one of their products. Now, this isn't necessarily the case. I don't want to diss accounting software because it makes life so much easier in some aspects, and it is really beneficial to a business. But where processes are relatively straightforward, predominantly for a landlord, for instance, a spreadsheet can be your better option. The software producers have been busying themselves over the last sort of 2-3 years with making their software compatible with the requirements of the Inland Revenue. So if you already use Xero or Sage or QuickBooks, in a year's time, you won't be having to do too much differently from what you're doing now, particularly if you file VAT returns using that software. You'll still need to register for Making Tax Digital for income tax, and you'll give e-permission for your software to communicate with the Revenue systems. But if you prefer not to have to learn to use an accounts package, but are familiar enough with, say, spreadsheets, these can be a much better option. We'll be putting together a template for clients to use and include with it some guidance for those who are not over familiar with things like Excel. But a spreadsheet on its own can't make quarterly submissions to the revenue, and you'll have to buy bridging software that acts as a link between your spreadsheet and the Inland Revenue systems. We deal with the VAT affairs for a number of our clients who are quite happy to use spreadsheets, and we use a piece of software produced by a company called Absolute Accounting Software. And in June last year, that software had been used to file over 1 million VAT returns. Not all our clients, but it's a figure they announced on their website with quite a fanfare. They have recently issued, or in the process of developing finalisation, equivalent software for MTD for income tax, which will be helping them finalise by testing a client on the system for them. This software costs the princely sum of £48 a year, so it is a real viable option if you don't want to go down the route of learning how to use Xero or Sage or one of the other packages. It's probably best if I point out at this point, for the sake of transparency, we make no commercial gain from promoting Absolute, but a former colleague is now director of the company. But that's neither here nor there, really, because suffice it to say, if the software didn't work, we wouldn't be using it. And after the webinar, we'll be providing you with a link to Absolute's website, which it already contains a lot of useful information about MTD for income tax. And in the next 6 weeks or so, they plan to upload a YouTube video of how their software works, so you can see how, I want to say, straightforward it is. It takes some practice getting used to, but it is really quite straightforward. So, making quarterly submissions, what does this involve? What's the time frame? And what is it that you're actually submitting? Because there's all sorts of rumours that you be downloading all your financial information each quarter, and that's just not the case. All you'll be submitting is their figures. They're not the backup to those figures. It's just your sales figure and your cost figures that make up the profit and loss account element of your records. But do be warned, though, if you are in the position where you are, you have a business and you have property income, you will need to be making separate submissions for those two elements, because the information is collected and goes to different parts of the revenue systems. So the periods covered by each quarterly submission have been set by the revenue. You can't change these, unlike for VAT, where you can choose your quarter ends. The ones for income tax will be April to June, July to September, October to December, and January to March. And we'll be suggesting to our VAT registered clients that they might want to consider aligning their VAT returns with these new quarter ends, just to reduce the amount of business administration that they go through. Similar to VAT returns, though, the deadline for each quarter is a month and a week after the end of the reporting period. So if we use April to June as an example, that is submitted in the first week of August, a month and a week after the end of June. Now, the revenue are not offering too much carrot in obliging taxpayers to adhere to this new MTD system, but there is a little bit of stick from them in the form of fines if you don't make your submissions on time. There's a point system. If you miss one deadline, there's no immediate consequence of that. But if you miss the second deadline within a year of the first, you get fined 200 quid. One of the stipulations from the revenue to the software producers is that taxpayers need to be able to see the liability that arises from each submission that they make. Now, from our perspective, this is an absolute nightmare idea, because so much can change between the raw data that we receive in producing a set of accounts to get to the final tax position. And there's the temptation for taxpayers to pay the amount shown as opposed to what we suggest that they pay. So this notion that taxpayers can see their liability, there's too much scope for it to go wrong. Which brings us to the last element, which is the submission of a fifth. This is effectively your return, the fifth return or the fifth submission required under the regime. It essentially takes the place of the tax return that you're familiar with submitting currently. The deadline for the submission is the same. It's the 31st of January following the end of the tax year. But on the fifth return, it provides the opportunity to adjust the figures that have been submitted for things like stock, year-end debtors, creditors, accruals and prepayments, interest on loans or a mortgage, and all that sort of thing. As matters currently stand, and this might change by the time we get there because the position is quite fluid, the software packages should be able to file the fifth submission to the revenue systems. And this will include, for instance, if you have P60 earnings or you've got a pension, that information should be, and this is a big should at the moment, that should be pre-populated because that information is held at the revenue. Your employer, if you have one, sends a P60 off to the revenue every year, and that then finds its way onto your tax return. But equally, the aim of the revenue systems is to be able to accept the fifth submission from our in-house software. So that part of the process potentially won't change very much from what already happens. So just to round things up, we're anticipating that our clients who need to adjust the most will be those who currently don't have any experience of the Making Tax Digital regime. This particularly relates to landlords who take the average landlord who we act for. They'll probably use a letting agent. The letting agent provides them with PDF documents, which then get passed on to us, and we use that information to work out the profit from the portfolio of let properties to include on their tax return. Now, although a PDF might feel like a form of digital record keeping, the software that produces those reports is not compatible with the revenue systems, and I don't expect that it ever will be, because letting agents will not want to become tax agents. So that is all I've got for you, and I hope you found it useful. I'm just going to see if we've got any questions come up. One question that's come through: is trust income included? even if it's generated from property income, it is not included. The property needs to be owned personally. This can be whether you own it jointly with a spouse or siblings. If it's in a trust, it doesn't apply. But thank you for the question. Let's just have a quick look back through. Just check that I've not missed anything. No, I think that's it. We've not got any more questions coming through. So, oh yes, we have. Sorry. What sort of price would the major accounting software charge? For somebody like Xero, this will be a bolt-on service, which I wouldn't expect them to be charging huge amounts for. Admittedly, I've not asked the question, but it shouldn't be excessive. If you use Absolute as an example, it's 40 quid plus VAT for the year. So I'd expect it to be in that sort of range. It shouldn't be excessively expensive. Yeah, I hope that answers your question. Just wait to see if anyone's going to ask another one. No, we're good, thank you. We will be there will be a survey at the end of the webinar that we'd like you to complete, if you could please, because it helps with our marketing and going for the next steps. Oh, we've got an anonymous question. So to clarify, it is simply income and expenditure. It is. If you are a particularly small business, you can give just two figures, your turnover and your total costs. If you're above the VAT threshold, which is currently £90,000, there's more information required. If you're familiar with the boxes on your tax return, I think there's 16 boxes. So there's one figure for your turnover and then 15 boxes for different types of expenditure. So it's the boxes that would go in to each of those expenditure types. If we already put on Excel, we just submit the return. We can do. Our aim is to be as helpful to our clients as they want us to be. I would suggest that, I'm not saying no, but if you have a look once it's up and running to see how the Absolute software works, once you get into the routine of it, it's not too tricky. But yeah, if equally, if a client just sends us their Excel spreadsheet, we'd be happy to file it. Obviously, there are costs involved in doing that, but it certainly wouldn't be the cost of 4 times your tax return, which is why we're trying to show clients what their options are. There are clients who quite happily file their own VAT returns. There's a number that we file them for because they're happy for us to. And this is exactly the same sort of routine. We're happy to help in whatever way you want us to. Okay, so thank you for your attention. Like I say, if any questions crop up that occur to you after the webinar's finished, if you ping an email to your normal contact point here at the firm, then probably the best way to go. But for the moment, thank you for your attention and have a good day.